Now it's time for our almost last paper.
So good afternoon to all of you. I really appreciate the opportunity to be here. What I'm asking your indulgence, not only because I'm the penultimate paper and you've all been sitting around for 3 days and I'm going to ask you to sit there for another half an hour, but also because this is a paper that doesn't have any regressions in it. It's an idea paper. In fact, it's an idea paper at the very beginning of the idea. So I'm just beginning to put together some things that I hope at some point will come together as a book. And what I asked my discussant to read is a very rough draft of an introduction for such a book. So that's what I'm going to talk about, is sort of the ideas I've been thinking about. Do I have a clicker somewhere? Thank you. Okay. So my question is, I'm going to talk about the attitudes we have toward the role of corporations with respect to stakeholders in addition to shareholders. And what I want to, it's not clicking. Oh, I see, that's only if I want to, okay. So the question is, who should be the beneficiaries of corporate governance? And this is a question that's been on the table. People have been talking about it for, in some ways, hundreds of years. The debate became prominent in the last 30 or 40 years, partly because of some things that happened in the 1980s that caused the idea of shareholder primacy to take hold. And so what I want to argue by looking at the history of the corporation is that this was a relatively, it wasn't a completely new idea, but it was an idea that it did not have deep roots in history, that the corporation should be run solely for the benefit of shareholders, and that it was an idea that took hold in the 1980s in the United States. It has since spread around the world, and that there were reasons why this happened in the 1980s, and there's indications now that it may be shifting back again. So what I'm going to suggest is that shareholder primacy is not necessarily the end of history, as Hansman and Crackman have said, but that it may have been a response to exigencies of the time, and that it may be something whose time is passing, and other things will take their place. So the earliest corporations were essentially extensions of government. Okay, in the late Middle Ages, charters were granted to townships and villages and municipalities because the charter assured them that they could be self-governed and that the king would not come in and trample on the rights of the people in that community. Monasteries, churches, religious bodies were granted charters so that they could be governed. It was understood that they'd be governed and accountable to the Roman Catholic Church, not necessarily, and that the property that they accumulated would not revert to the king when the rector of the monastery died. Okay, the trading companies, which all of you are intimately familiar with, I'm sure, these were used as definitely extensions of government in the sense that the king gave rights to a group of traders, okay, but they were expected to build ports, to wage war, to capture slaves in some cases. They were given all kinds of governance duties along with their rights that they had, okay. This was partly to defend their rights, okay, but it was in effect an extension of the foreign policy operation of the king to grant these rights to the trading companies. Another group of companies that were early examples of corporations were the colonial settlement companies. The companies that were given the right to settle certain areas in what's now the United States, in North America and in the other Americas, okay, were chartered with a specific task to go and create communities that they were then to govern. Okay, that they were given governance rights over those communities. So they were, early corporations were really extensions of government, okay? The Virginia Company and the Hudson's Bay Companies, they were chartered to establish colonies, okay? Their charters became the model by which the constitutions were later written for those states in the United States. They were based on charters that had been granted to them as corporations, okay? In the new United States, once the revolution was over and we had states, the British, while those states were still British colonies, they had followed the law of Britain, okay? Once the revolution was over, they began state by state issuing charters, and they were issued charters much more liberally than Britain did, because Britain was still controlled by the Bubble Act, okay? Still, by 1800, there were only about 300 charters that had been issued in the United States for business corporations. They were virtually all for infrastructure companies. They built water supply, banks, insurance companies, and today we would call those things public-private partnerships. So they were created to provide services in the community that were needed and that the government really couldn't create on its own. It didn't have the resources, okay? I'm going forward or backwards here. What's happened? Okay. In the 19th century, the demand for use of the corporate form for business purposes grew explosively. And it became a problem that every charter had to be granted by special act of the state legislature, because they were overrun with requests to do this sort of thing. Plus, there was a lot of concern that legislatures were using these corruptly. Okay, they would grant charters to business groups that they favored that, not surprisingly, were people that put money into their political campaigns. Okay, so around the middle of the 19th century, states began passing generalized statutes that allowed corporations to be formed simply by filling out and registering with the government and meeting certain requirements. By the early 20th century, any person could form a corporation in the United States for almost any purpose. And this had the effect of democratizing the use of the corporate form. It was available to anyone, okay? And depoliticizing it. Again, for the same reason, it was available to anyone. But it severely weakened the expectation that the corporations would serve some sort of public purpose. They didn't have to get permission from the state legislature to satisfy some sort of public purpose. Corporations were, such as railroads, however, were still viewed as having a public function. So it's still true that a great many corporations were put in place with an expectation that they would serve some sort of public function. As more and more business corporations were formed, though, without that built-in expectations, without a charter that specifically limited their activities and said they must serve some public purpose, the government, state and federal government, began putting in place various kinds of laws to regulate corporations, precisely because they were no longer being expected to be regulated by their charter. So we saw antitrust laws, we saw laws put in place that would regulate rates on the railroads. Later, we saw laws put in place that would regulate food and drug and safety and a variety of different things that began to have to be regulated separately. Were these corporations then still considered to have some sort of public purpose? Or were they considered to exist only for private profit? And that debate first materialized in legal literature in the 1930s. And we had a debate, famous debate, in a series of essays in the Harvard Law Review, in which Adolph Burley and Merrick Dodd took the different sides in that debate. Adolph Burley said that the managerial powers must be held in trust for shareholders, for stockholders, as the sole beneficiaries of the corporate enterprise. Merrick Dodd, on the other side, argued that public opinion, which ultimately makes law, has made and is today making substantial strides in the direction of a view of the business corporation as an economic institution which has a social service as well as a profit-making function. Now, Burley came back and he said, you can't abandon the idea that they have to carry out their activities for the sake of shareholders until you're prepared to offer a clear and reasonably enforceable scheme of responsibilities to someone else. That's the basic outlines of the debate that we're still having today about corporations. It's interesting, though, that Adolph Burley later in the 1950s conceded. He basically said Merrick Dodd was right, okay? That we all understand corporations have some sort of public purpose. In the 1950s through the 1970s, public sentiment shifted strongly in the direction of believing that corporations had public responsibilities as well as private shareholder value responsibilities. Now, not everyone agreed, okay? Milton Friedman argued against this idea, for example, okay? But the fact that Milton Friedman's essay made such a splash tells you how entrenched the opposite point of view was, okay? Numerous publications by business organizations in the 50s, 60s, and 70s affirmed that corporations and corporate leaders recognized that they had responsibility to serve public as well as private functions. This idea began to shift dramatically in the 1980s in the United States. And I want to argue that there were 4 things that happened during that decade that were partly responsible for that shift. And those changes were important, but they shouldn't be interpreted to mean the new reality for all time, okay? The first of these is that we had incredibly poor stock performance in the United States in the publicly traded sector of corporations from 1968 to 1982, okay? 12, 14 years of very poor stock. This is the 1970s, okay, in the Dow Jones Industrial Average. This is the 1970s. This is the period we're talking about. For an extended period of time, investing in the stock market was a losing proposition. If you bought into the S&P 500 in 1969, okay, and held to 1981, you lost money, okay? Second factor, beginning of the 1980s, Paul Volcker we had inflation building up in the United States, and to get inflation under control, Paul Volcker stepped in, and he was going to drive interest rates up in order to rid the economy of inflation. The nominal rate on Treasury securities shot way up. Inflation quickly subsided, but interest rates didn't come back down. So we had real interest rates that were higher than we'd ever seen them historically in the United States. And the implication of this was that the cost of capital was really high. So we have very poor returns on capital historically. Suddenly we have a very high cost of capital. Implication is lots of corporations have what Michael Jensen called free cash flow. Okay? I never understood the argument that the takeover movement in the 1980s was about correcting bad management, because I never understood the argument that bad management happened in waves. Okay? I think bad management ought to be more or less evenly distributed across the population of corporations. But what we saw was, in the 1980s, a sudden clampdown on what was called bad management. And I argue that that was just the playing out of the fact that lots and lots of corporations suddenly had what Michael Jensen called free cash flow. So here's the 1980s, okay? Real interest rates at an extraordinarily high level for an extended period of time. And it took a long time for them to come back down to normal. Now they've been below normal for an extended period of time. It shouldn't be surprising that some of our ideas that came into play in the 1980s may be being re-examined, okay? So the effect was free cash flow. In corporations, some changes had to be made in corporate governance in order to correct that. And so what we saw was the third factor of the 1980s, which was the hostile takeover movement, okay? A wave of hostile takeovers and leverage buyouts occurred in the 1980s. We hadn't seen those kinds of transactions, certainly not in that kind of significant numbers at any time before then, okay? Many of these were leveraged buyouts, so leverage was used as the mechanism to force firms to pay out cash flow instead of retaining it, to try to increase the return to investors in financial capital and turn these corporations around. States responded, interestingly, 32 states in the United States responded by passing what were called constituency statutes. The point was to affirm that corporations have social duties as well as duties to increase wealth for shareholders at a time when they understood there were increasing pressures to increase, to go along with these, the restructurings that were designed to pay out cash flow. Delaware courts hesitated, but eventually Delaware courts have basically bought into the idea that, that corporations should be run to maximize value for shareholders, okay? The fourth factor was the fact that Jensen and Meckling and other scholars came out in the late 1970s providing a theoretical rationale for what was going on. And I think the impact of that can't be overstated. What we had was a situation, we had a solution in place which was to protect the rights of shareholders, to encourage takeovers, to encourage restructuring, okay? And we have a nice theoretical story for why that should be happen. So they predicted that if a corporation is not managed to maximize share value, its share price would be low, the corporation would be attractive target for a takeover by an alternative management team, and that's in fact what we saw. It was an incredibly powerful moment for academia, if you will, that Jensen and Mecklen put forth that idea, and then it played itself out in the 1980s. The implication was that hostile takeovers were good for the economy, okay? So in Pradeep's presentation a little while ago, he assumed that the takeover offers were a good thing and that management should not resist it. That's the assumption we've made for most of the last 30 years. In fact, there's been very mixed results on this question, okay? We've seen that the price of the target company goes up, okay? Target company shareholders do very well, but the implications for the underlying management of the company have been very mixed. And it's never been able to show where that premium, how the premium that shareholders collect in a takeover plays itself out. Okay, so stakeholders, if we're going to have if we're operating on a theory that that corporations have to maximize share value, there's not a lot of room for stakeholders. And what I want to argue is that the pendulum may be swinging back. There's a growing concern in the United States about the problem of short-termism. We see a tremendous growth and success for social responsibility, sustainability investing. Something like 25%, 20 to 25% now of the money invested is invested in special funds that claim to be focusing on social responsibility and sustainability. Big investment funds like BlackRock and Vanguard are focused on the problem of short-termism. The financial crisis brought to all of our attention the risks that are brought into play in the economy when the focus is too intensely on maximizing share value. We all know, all of you are finance specialists, you know that shareholders have an enormous incentive to have the corporation take on too much risk. So I'm very interested in India's Companies Act and the fact that they're now explicitly saying that corporations have a duty to pay attention to larger stakeholders. So I'll stop there. Thank you.
Thank you, Margaret, and thank you, Yesha, for asking me to review this very interesting chapter of a book. I really am looking forward to the book, but in this presentation, I want to just push back on some of the ideas. So I don't have much to say about the historical evolution of where we are, but I do want to push back on a few ideas that you have placed, given the Indian experience that we've had. So since we are running out of time, I will not focus on what the book is going to be about. But let me just focus on some of the ideas that I got from reading that chapter, right? So one of the things that you say in the chapter was that corporate charters imposed no limits on what corporations could do or where they could do it, as long as they did not violate specific regulations. So this was a change from the olden times when they were given a specific charter. I would argue that that was a great thing. Okay, so freedom by itself is a value. If people can, with their money can do X, Y, Z and follow the laws of the land, I think that there is argument to be made that we should not be asking for more. And this might have given us uncertain jobs in developed economies, but the fact that you could have these corporations have actually meant a lot of economic development for countries like India and China. So a lot of people have come out of poverty because there was a change in the way the corporations function, and perhaps this is a good thing, and this has given us a lot of gain. So that's one idea that I would want to push against. The second is that one of the things again that you mentioned repeatedly in that chapter is that corporate executives had deep roots in the communities and felt a sense of responsibility, and today that does not seem to be the case. Today it seems that the executives are, do not even belong to the country, the community, and then therefore they have no sense of responsibility. And again, I would say, is that such a bad thing? Because I really don't know whether it is easy to pinpoint what behavior to expect from whom, as long as, again, laws are not being violated. In India, for example, connections to the community have given us a set of different problems. So for example, if you've been hearing the entire bad loans crisis that we have in India, that has been because there have been strong connections between politicians and the corporate class. If we have strong community connections in India that make entry barriers very, very high, it's extremely difficult for outsiders to enter businesses. And so actually I would argue that not having community connections would be a great thing. Similarly, the literature on problems of promoters in India is very vast. We would love it if we got to a place where we had more dispersed shareholdings and less ties to the community, if you will. And so again, there's a quote in the chapter, and about what is good for my company is good for my country. And so on. So I would argue that, perhaps what's good for my community may not be good for my country, and maybe what's good for my country may not be good for the world. And therefore, I really don't know how to interpret the fact that executives don't have deep roots in the community. Maybe it's not such a bad thing. And finally, there is another point that I would like to push back a little bit is that you say that basically corporate managers are not thinking about what impact it will have on society and on the people that they live with. And again, here I would say that mandating responsibility has given us a lot of problems in India. So we heard a paper in the morning which showed an experiment about SSI reservation. So we had reserved multiple classes of industries because this was responsibility towards people who would otherwise not be able to come into the marketplace. And I think that that has really pushed us back. Or even the paper that we saw on CSR, which is now mandated 2% CSR, the results are mixed. So the fact that the government has mandated companies to do CSR, it's not at all clear that that is going to give us any benefits, and perhaps there are costs to such mandating rules. So, similarly, we have n number of regulations in n number of fields. Who can enter what market? In what form can they enter? For example, if you look at the education sector in India, for-profits are not allowed because we want to do good by the community and not allow people to make profits. And actually that has given us a huge mess in the education sector. So again, I'd like to sort of say that, mandating responsibility, requiring ties with the community may not be very good things given the experience that we have had in India. And I agree with you that, corporations should not be able to operate with immunity, and that we do need to hold the CEOs and boards of directors accountable to whatever it is that they are doing. But I think that accountability, in my view, would be a little more narrow than the way you are placing it, which is, do they obey the law? Are we able to get better enforcement? And just stop there and not ask questions around responsibility towards society. And ultimately, I think all change comes when society demands a certain kind of behavior, and we internalize what is good and what is bad and what is acceptable and what is not. And this kind of change and this kind of pushback rarely comes because governments mandate a certain kind of behavior. They come because society pushes back. And some of the examples that you give are examples of how perhaps society is pushing back, and we should welcome those. But we should be careful about what we mandate corporates to do. Thank you.
Renika did a fantastic job, at least in keeping her comments short. So that gives us some time for some questions. I want to go around, so is there anyone on this side with a question? You're all exhausted. Okay, all right.
Yeah,
Go ahead.
So I have a question for you, Margaret. I always enjoy listening to you talk about the history of the corporation. So it seems to me that the original corporations that you talked about historically, the benefit that the proprietors of the corporation received was a monopoly, a monopoly to do something. And if the government is giving you a monopoly to do something, then maybe it makes sense to, in return, have to give something back to the government, such as to operate in a way that is in the public interest. Today, when you start a corporation, you don't get a monopoly. The primary benefit you get today is that you shield the owners from legal liability for what the corporation does beyond what their investment is. Do we think that given that the benefits the owners of a corporation get today are so much different than they used to be, that the corporation owes the same duty to the public that it did originally?
Is this on now? Yeah, okay.
Well,
So, okay.
let's accumulate some questions.
I didn't, no.
I have a quasi-comment, quasi-question. So just like we're talking of, do companies really differ in terms of the responsibilities of the people? Is the social constituency of the company also expanding?
I can't
Is
hear
the social constituency of the company also expanding? So they not only owe it to their people now, if we can associate people to company. Because, for instance, the Dodd-Frank Act, Chapter 1502, deals with conflict material now. Or what we saw in the garment industry led to a huge international movement about corporate responsibility. And that also kind of substantiates what Renuka was saying, that society itself emerges and also responds. And the great thing about law can then be to seize that moment opportunistically, as in when we see a movement or a momentum gathering, and then kind of create soft laws around it and give push to, for instance, the compass principles. So mandatory may not be the best solution. However, as and when society responds, the critique here is that it's always post hoc, but there is a way that it can be made more enduring, and maybe mandatory may not even be needed at one point.
I had one more comment about the original idea behind shareholder primacy. At least part of it to begin with was premised on the idea that a corporation and society might be more efficient if corporations specialized in maximizing shareholder wealth, and then shareholders could voluntarily choose what they did with the capital gains and dividends, which could involve things such as philanthropy. So I think that's perhaps something that needs to be considered in terms of the efficiency of specializing and therefore enabling shareholders, who are effectively voters, to spend the money in the way that they'd want to choose, rather than having, say, directors choosing for them which causes to invest in. And that perhaps needs to be addressed, I think.
Can I just add on to that and say, to take it one step further, that the corporation should maximize wealth, and not necessarily that the shareholder should choose where the wealth goes, but the government can tax the wealth. And so isn't it better to let corporations maximize wealth and then move the wealth around in a way that's socially useful through taxation?
Go ahead.
So the last one I'll take on first, because part of the problem is that corporations can move the wealth around to avoid the taxation. And so the fact that they no longer have deep ties to communities or even to countries anymore means that wealth is moving all over the place, and more and more of the wealth is of the type that doesn't really exist in space anyway. So it's intellectual property and patent rights and networks and these things that don't have a natural tie to a particular geographic location, and so they can escape taxation altogether. And I think that we have that situation has emerged, given the other context that we've been in which we have pretty systematically around the world decided that it's okay for corporations to do what they need to do to maximize share value without regard to the implications of that. And we've also eliminated the regulations, and we've allowed them to relocate and escape taxation. So I think the balance has shifted. We aren't able to we're finding it more and more difficult to impose the regulations that were the flip side of giving the freedom to any group that wanted to form a corporation. We aren't successfully regulating much of the activities, and that's really, I think, what concerns me. On the social constituency of corporations is expanding. Where I didn't have time to talk about this here, but where I'm going with this is that there are some natural forces that are emerging, okay? Actually, I won't call them natural forces. There are some social forces that are emerging that are providing some counterweight to it. And that's the fact that these mechanisms are not very well worked out, okay, and they work for some purposes, but they don't work for others. I think there has been a significant movement, as I'm sorry, I don't know your name, but as our questioner asked about, in the garment business, for example, a very widespread movement to try to get better conditions in the factories so that the employees in those factories are not forced to work 80 hours a week. Child labor has been largely eliminated, at least from the factories that are serving international clients. And it's because the customers were able to say, we don't want you to do that. We're willing to pay a higher price for the goods that come out of the factory if we can know that they're not. They don't have 12-year-olds in there working at the sewing machine, so that and unable to go to school. All of this is imperfect. It's not playing itself out thoroughly. But I think there are social movements out there that are pushing in the other direction, even if governments can no longer be the ones that impose the constraints. Anyway, so I'm trying to look at all these big questions, and I'm not sure how I'm going to come out on some of these questions yet. So I appreciate your questions, and clearly there may be some benefits to allowing corporations to specialize in just trying to get maximize their financial returns. But I think what we saw during the financial crisis was that shareholders have an incentive to take on too much risk, and then they externalize that risk onto the rest of society, and that's not a good thing. So if we can force the corporations to internalize their costs, which I don't think we're being very successful at so far, then maybe it makes sense for them to try to maximize value. But if they're not forced to internalize their own costs and they're allowed to externalize the costs, take on the risk and capture play a heads I win, tails you lose sort of game with the rest of society, that's problematic, and we need to be looking for ways to get that under control. And thank you, Renuka. I didn't get to thank you. I really, Renuka was responding to the paper that I wrote, and I was presenting something that was a little different from that. So if there was a disconnect, it's my fault for not sticking to my to the paper that I wrote, that I submitted in my remarks.
Okay, great. So that gives us quite a bit to think about, especially as we head into the final session of the day, where we'll also talk about big questions. So let's give a round of applause. for everyone in the previous session.